This video covers Learning Objective 3, Part 3, Units of Production Depreciation. In Chapter 7, Plant Assets, Natural Resources, and Intangibles. So let's get started. There are three main depreciation methods, including straight line, units of production, double declining balance. We are covering the units of production method in this video. With the units of production method, a fixed amount of depreciation is assigned to each unit of output or unit of service produced by the asset. The depreciable cost is divided by the asset's useful life in units of production to determine this amount. The per unit depreciation expense is then multiplied by the number of units produced each period to calculate depreciation. The units of production method is appropriate for assets that wear out because of use, such as cars, engines, and printers. Let's go through a quick reminder of some basic depreciation concepts before we go through a units of production depreciation example. The book value of a plant asset is its original cost less accumulated depreciation. Accumulated depreciation is a contra asset that contains a running total of all depreciation expense for that asset over its lifetime. At the end of an asset's useful life, its book value will be equal to its estimated residual value. There are a few formulas we need to calculate depreciation using units of production. Depreciable cost is calculated as the original cost minus the residual value. The depreciation expense per production unit is the depreciable cost divided by the total estimated production units. The depreciation expense per period will be calculated as the depreciation expense per unit times the number of production units this period. Now we are going to go through a units of production depreciation example. Cool Freeze Company bought a used truck on January 1st, 2019 for $13,000. The estimated useful life of the truck is 5 years. Its estimated residual value is $1,000. Assume that Cool Freeze uses the units of production method of depreciation. To use the units of production method, we need some additional information. Here is a table that gives the projected mileage on the truck for each of the 5 years in the estimated life of the truck. Those 5 years worth of miles can be summed to the total estimated mileage for the truck, or 100,000 miles in our example here. Now we can use those formulas to calculate the units of production depreciation for our ice cream truck example. The depreciable cost is calculated as the original cost of $13,000 minus the residual value of $1,000, giving us depreciable cost of $12,000. The depreciation expense per unit is equal to the depreciable cost of $12,000 divided by the total units. Now the units here are miles, so we will take the 12,000 divided by 100,000 miles to get the 12 cents per mile as the units of production mileage rate. Then we will be calculating depreciation expense per unit of 12 cents per mile times the number of units or miles during the period. We have the units of production depreciation table set up. Notice at the top that I have put the original cost less the residual value to give us a depreciable cost of $12,000. I take that $12,000 divided by the total miles of $100,000 to get the depreciation cost per mile of 12 cents. Now we have a year column, a miles driven column, depreciation expense per mile column, annual depreciation expense column, accumulated depreciation column, and a book value column. The first row will hold the original cost of $13,000 in the book value column. For the year 2018, I will fill in the 15,000 miles driven as given in the table a few slides ago, times the depreciation expense per mile of 12 cents to get the annual depreciation expense of $1,800. Accumulated depreciation in the first year will be equal to $1,800 because that is the only depreciation we have so far. The book value is always original cost less the accumulated depreciation. So here we have $13,000 minus $1,800 gives us a book value at the end of the first year of $11,200. At the end of the second year, 2019, we can fill out the table with the miles driven of 30,000 times the 12 cent per mile depreciation expense, giving us annual depreciation expense for 2019 of $3,600. Accumulated depreciation is last year's $1,800 balance plus this year's depreciation expense of $3,600 to give us accumulated depreciation at the end of 2019 of $5,400. Book value at the end of 2019 will be the original cost of $13,000 minus the accumulated depreciation of $5,400 or $7,600. We can calculate the depreciation for 2020 as well. We will take the miles projected to be driven of 20,000 miles times the 12 cent depreciation expense per mile to get the annual depreciation expense for 2020 of $2,400. Accumulated depreciation at the end of 2020 will be last year's $5,400 accumulated depreciation balance plus this year's annual depreciation expense of $2,400 to give $7,800. The book value of the ice cream truck at the end of 2020 will be the original cost of $13,000 less the accumulated depreciation of $7,800 or $5,200. We would follow exactly the same steps for years 2021 and 2022. Notice that after all 5 years are completed, total miles driven is 100,000 miles and the ending book value is $1,000, which is equal to the estimated residual value. And that concludes this units of production example. Now we have a few knowledge check questions coming up to test your understanding of this material. After I read the question, pause the video and try to answer it. Once you restart the video, I will be walking through the answer for the question. Let's go. The first question reads, which of the following statements is true about calculating depreciation using the units of production method? The choices are, a variable amount of depreciation is assigned to each unit of output. The estimated residual value is not used with the units of production method. Depreciation expense depends directly on the amount of output or usage, or the residual value at the end of the asset's useful life will always be zero. The answer is, depreciation expense depends directly on the amount of output or usage when using the units of production method. The second question reads, on January 1st, 2019, Jubilee Corporation acquired equipment for $760,000. The estimated life of the equipment is 5 years or 37,000 hours. The estimated residual value is $20,000. If the company uses the units of production method of depreciation, what will be the debit to depreciation expense for the year ended December 31st, 2019, assuming that during this period the asset was used 5,000 hours? The choices are $102,703, $148,000, $100,000, or $105,405. The answer is $100,000. To get the answer of $100,000, we start by taking the original cost of $760,000 and subtracting the estimated residual value of $20,000 to get $740,000. We divide the $740,000 by 37,000 hours to get a depreciation rate of $20 per hour. To calculate the amount of depreciation expense for the year ended December 31st, 2019, we would take the $20 depreciation rate times the 5,000 hours the asset was used during the year to arrive at depreciation expense for 2019 of $100,000. That concludes our review of the units of production depreciation method. Thanks for watching.